Good morning. Welcome back to the War Room. I am Malik. Before we dive into the terminal this morning, I want to issue a brief apology for the radio silence over the last few trading sessions. We encountered some internal operational issues that temporarily kept me away from the microphone. Those issues have been completely resolved and the War Room is fully back online. We have a massive amount of ground to cover, so let us get straight to the data. Today is Thursday, April 23rd. There is a massive, highly dangerous disconnect currently forming between the macroeconomic headlines and the corporate reality on the Pakistan Stock Exchange. If you have been looking blindly at the tape over the last 48 hours, the market feels unstoppable. The KSE 100 index has relentlessly pushed higher, floating above 173,150. Institutional capital has been aggressively pricing in the survival of our foreign exchange reserves. We just secured a critical $3 billion deposit rollover from Saudi Arabia. The sovereign default risk has been temporarily neutralized, and the algorithms are buying the relief. They pushed over 1.16 billion shares of volume into the equity market. But while the state's balance sheet is breathing, the corporate boardrooms are suffocating. The International Monetary Fund's mandate remains absolute: no fuel subsidies. The 520 rupee diesel barrel is now a permanent structural fixture of our economy. Today, we are going to see what happens when the unstoppable force of sovereign liquidity meets the immovable object of a dead industrial margin. Today is the day the corporate balance sheets strike back. I am going to show you why the global freight data and the local bond markets are screaming that a recession is already here, and why today's historic avalanche of corporate earnings will force a violent reality check on the tape. Let us dissect the pure global data that the equity market is actively choosing to ignore. As of this morning, satellite imagery and Bloomberg terminal data confirm that the Strait of Hormuz is functionally paralyzed. Over 18 million tons of crude oil are physically trapped in the Persian Gulf. Because of the ongoing strikes, major global maritime insurers have officially canceled war risk coverage for the entire region. The result, Brent crude has surged past $120 a barrel. Furthermore, the Shanghai Containerized Freight Index, the global benchmark for shipping costs, has spiked by 300% as vessels are forced to reroute entirely around the continent of Africa. This is no longer a localized temporary geopolitical event. This is a total structural failure of the global energy supply chain. For Pakistan, the math is inescapable. Because the IMF has strictly forbidden Islamabad from providing any fiscal life support to the industrial sector, the 520 rupee diesel barrel is the baseline. Portfolio managers injected 1.16 billion shares of liquidity into the system because the macro-level default risk is gone, but they are completely ignoring the micro-level reality that manufacturing companies cannot turn a profit when transport logistics have doubled in cost. If you want to know what's really happening in the economy, you don't look at the stock market, you look at the bond market. While retail traders were buying the Saudi bailout on the stock exchange, institutional bond traders were quietly hitting the panic button. The State Bank of Pakistan just concluded its latest treasury bill auction, and the results are terrifying. The 6-month T-bill yield just violently spiked to 24%. When the stock market goes up, but short-term government bond yield explode to 24%, it means the smartest money in the room is officially calling the equity market's bluff. Bond traders are pricing in massive, sustained inflation caused by the permanent 520 rupee diesel barrel. They know the state bank will be forced to hike interest rates again to combat the imported inflation from $120 oil. When diesel stays at 520 rupees and interest rates sit at 24%, companies don't just suffer from high costs, they suffer from absolute demand destruction. The consumer simply breaks. This 173,000-point ceiling is an illusion built on foreign reserves. It has not yet been stress tested against the Q3 earnings data. That stress test begins today. Today, Thursday, April 23rd, the PSX calendar is dropping a synchronized avalanche of critical board meetings and earnings reports across every major sector. This is the macro reckoning. Mark your screens. The Energy and Risk Corps, 10 a.m. The Hub Power Company Limited, HUBC, dropping third quarterly accounts. This is the absolute epicenter of the energy grid. With the IMF demanding strict tariff adherence, Hub Power's earnings will reveal exactly how fast the circular debt is accelerating. If their receivables are exploding, the entire energy board will gap down. Mari Energies Limited, releasing accounts simultaneously, a massive piece of the upstream energy puzzle. Pakistan Reinsurance Company Limited, holding a mystery non-financial meeting. When the state's primary reinsurer holds an emergency meeting during a global oil shock, they are actively repricing systemic risk. Watch for forward guidance on corporate insurance premiums. The Cyclical and Manufacturing Corps, 10:30 a.m., 12 p.m. Lucky Cement Limited, 10:30 a.m. Cement is the ultimate proxy for national economic health. Early data suggests national cement dispatches have plunged over 35%. Lucky Cement's forward guidance today will reveal the exact scale of the demand destruction. If contractors have stopped pouring concrete because freight is too expensive, the 173K index floor will not save the cyclical board. International Steels Limited, 12 p.m. Steel has a massive logistics footprint. This earnings report will cut straight through the liquidity illusion and expose the unvarnished margin destruction caused by the 300% global freight spike. The consumer and agriculture collapse, 11 a.m., 2 p.m. Indus Motor Company, 11 a.m., holding a critical board meeting. Auto financing is mathematically dead when T-bill yields are at 24%. Watch this tape for announcements regarding extended plant shutdowns or massive inventory pileups. Engro Fertilizers Limited, 2 p.m. Agriculture runs entirely on diesel logistics. This earnings report will show exactly how much of the fuel shock they were able to pass on to the farmer and how much they had to eat themselves. Here is your battle plan for the Thursday reckoning. Number 1, do not trade the illusion. The market is floating at 173,000 because the Saudis rolled over our debt. Do not confuse a sovereign bailout with a corporate recovery. Do not act as exit liquidity for the institutions pushing 1.16 billion shares. Number 2, listen to the bond market. Equity algorithms lie, bond yields do not. A 24% 6-month yield means institutional cash is fleeing the stock market and seeking guaranteed inflation-protected returns. Do not fight the yield curve. Number 3, the demand destruction pivot. Your focus today is entirely on the revenue line, not just the profit line. When Lucky Cement and Indus Motors report today, look to see if top-line sales have collapsed. If the consumer is broken, no amount of corporate cost-cutting will save the stock. We are macro realists. We see Brent at $120, we see T-bills at 24%. We wait for the balance sheets to prove that these companies can survive without IMF-banned subsidies. Keep your armor on, protect your capital, and command the Thursday. Disclaimer: StopSense is an educational platform. I am an analyst, not a financial advisor. The market is facing unprecedented macro volatility. Trade at your own risk.